Alright, children, welcome back. Sorry, in the previous video, we just did 10 problems. Alright, in this, we'll be doing more. 12th one, to assess the efficiency of inventory in the business. We use inventory turnover ratio. Operational efficiency ascertain பண்றதுக்காக தான் turnover ratios இருக்கு. Okay. If 365 is divided by inventory turnover ratio, it becomes a measure of average age of inventory. If you're buying and selling inventory, assume 10 times you're buying and selling. There are 365 days. 10 times your inventory is coming in completely and going out completely. So 36.5 days is the number of days for which your inventory remains in the go down. So that is your average age of inventory. Understood? This can be explained in a much better manner, but as in அந்த மாதிரி class இல்லை இது நம்ம question solve பண்ற class அப்படின்றதுனால I'm going to go deep into this. Okay. The dash may indicate that the firm is experiencing stockouts inventory turnover ratio. If average inventory is 1 lakh and closing inventory is 2 times more than that in the beginning, value of closing inventory 1 lakh, opening inventory X nu vechikalam, appo closing inventory enna varukum 2 times more, so X plus 2X divided by 2, so 2 lakhs is equal to 4X, X is equal to 50,000. Opening stock is 50,000. 50,000 plus closing stock is equal to, by 2 is equal to 1 lakh. So this becomes 2 lakhs. So closing stock is 1,50,000. You want me to solve this? 2 lakh is equal to 50,000 plus closing stock. Closing stock is equal to 1,50,000. Okay. Done. Collection of debtors will not affect current ratio in any manner, because when you collect money from debtors, cash increases, so current asset increases, and debtors decreases, so current asset decreases. But the 17, the two basic measures of operational efficiency of a company are basically turnover ratios, so inventory turnover ratio and working capital turnover ratio. Compute total asset turnover ratio from the information given below. You have fixed asset net of depreciation 4 lakh, current assets of 3 lakhs, revenue from operation of 14 lakh. Okay. Total asset turnover ratios are revenue from operation divided by that whatever it is. If it's working capital turnover ratio, then it will be working capital. In this case, it is total assets turnover ratio. So it will be total assets. Revenue from operation divided by total assets. So 14 lakhs divided by total assets, which is 7 lakhs. So that will be 2 times is the correct answer. All right, children. The following which ratio is not part of activity ratio? Debt equity ratio. Debt equity ratio is part of solvency ratios. Which of the following is not a type of activity ratio? Debt equity ratio is not a type of activity ratio. Dash are especially interested in the average payment period, since it provides them with a sense of bill paying patterns of the firm. Average payment periods, lenders and suppliers are interested, because average payment period talks about how often the organization pays, how soon the organization pays. நம்ம எவ்வளோ நாளில் திருப்பி தரோன்றதை சொல்றது தான் நம்மளோட ஆவரேஜ் பேமெண்ட் பீரியட். ஆவரேஜ் கலெக்ஷன் பீரியட் நம்ம டெட்டாஸ்லேருந்து எவ்வளோ நாளைக்குள்ள வாங்குறோம், இன்னும் நம்ம எவ்வளோ நாளில் திருப்பி தருவோம்னு யாரு கவலைப்படுவாங்க? நம்மளோட கிரெடிட்டர்ஸ், who are lenders and suppliers. Okay. Next we have a numerical. Total purchases 1,70,000, cash purchases 16,000, purchase return 8,000. Creditors turnover ratio they're asking. Nice. For creditors turnover ratio, it is total credit purchases divided by average creditors. That is opening creditors plus closing creditors divided by 2. So in this case, we need to look at total credit purchases. They've given that total purchases is 1,70,000. Adala cash purchase 16,000. Adha kalichino. Purchase return 8,000. Adhayum kalichino. So that will give us 24,000. 20,000 portion of 50. 4,000 portion of 46. 1,46,000. 1,46,000 divided by creditors in the beginning and creditors at the end. So 24,000 plus 32,000. It's actually average trade payables. Creditors trade payables includes creditors and bills payable. So that is 56 divided by 2, 28,000. Okay, so 1,46,000 divided by 28,000. That will be 5.21 times. Okay, I use a calculator. I don't know if you're able to see it. 5.21 times. All right, moving forward. Average payment period is particularly useful for suppliers and lenders. They'll know when we pay. Total purchases solved 5.21 times. The formula for calculating trade receivable turnover ratio is credit revenue divided by average debtors plus average bills receivable. This is more correct. This is also sounds like correct, but this is more correct. The credit sale of Messrs. Dinesh and Sons is 21 lakhs. Its debtors and bills receivable at the end of the accounting period amounted to 2 lakh and 1,50,000. What will be it sounds easy. What mistake the children will do, I'll tell you. They've given two numbers. So what they'll do is they'll add the two and find out the average and write it in the denominator. The debtor turnover ratio is total credit revenue divided by average trade receivables. Average trade receivables include bills receivable and debtors. And for both of them, the end of the accounting period number is given. So total average trade receivable is 3,50,000. Here the opening is not given. When the opening is not given, you are supposed to ignore it and just write what is given. You're not supposed to find the average. You're supposed to find the closing. You're not supposed to divide the closing by 2. You're supposed to take the closing as the average. So 21 lakh total revenue from operation divided by closing trade receivables, which is 3,50,000. So 4 zeros get cancelled, obviously. This is 30 and this is 5 times 7 all 6 times is the correct answer. 6 times is the correct answer, my dear children. Moving forward. The dash is useful in evaluating credit and collection policies. Collection, what we collect from our debtors, correct earlier. So average collection period is the correct answer. ABC company extends its credit terms of 45 days to its customer. ABC company tells all its customers to pay in 45 days. The average collection period is, when is it considered poor? We tell them to pay in 45 days. If they pay in 30 days, is it poor? No, good. 36 days, no. 37 days, no. But we tell them to pay in 45 days, they're paying in 47 days. They're taking more time to pay. So this is bad for us, right? So yeah. So C is the correct answer. Debtor turnover ratio is net credit revenue divided by average trade receivable. So C is the correct answer. Debt collection period is 2 months. Trade receivable turnover ratio will be how much? See, collection period is total months divided by debtor turnover ratio. So collection period is said to be 2 months. Total months is 12. Debtor turnover ratio we don't know. So debtor turnover ratio is equal to 12 divided by 2, which is 6. Understood? 6 times. Moving forward, to calculate trade receivable turnover ratio, dash is divided by average trade receivable. Net credit revenue from operations. Understood? 32nd problem. A company extends credit term of 45 days to its customers. Its collection will be considered poor when 45 days கொடுத்து அதோட அதிக நாள்ல தான் அவங்க ரீபே பண்றாங்கன்னா that will be poor for us. So 52 days is the correct answer, my dear children. All right, moving forward. Cost of revenue from operation is 15 lakhs, current asset 4 lakhs, current liability is 1,50,000. Working capital turnover ratio. Yeah, working capital turnover ratio. Revenue from operation divided by working capital. I think we already solved this, no? Yeah, solved it. If revenue from operation is not given, just take cost of revenue from operation. We solved it definitely. 15 lakhs divided by current asset 4 lakh, current liability 1,50,000. So 2,50,000 is the working capital. 4 zeros will get cancelled. 150 by 25, 15 by 25 into 10, 3 times, 5 times, 30 by 5, 6 times. Answer is 6. Right, which of the following is not part of activity ratio? Interest coverage ratio is part of solvency ratio. 35th question. Current asset at cost 24 lakhs, credit sales 68 lakhs, cash sales 6 lakhs, sales return 2 lakhs. What will be current assets turnover ratio? For anything, it is revenue from operation divided by whatever they are asking. So it is current asset means it's current asset. Okay. Revenue from operation is how much? 68 lakhs. My 68 lakh plus 6 lakhs cash sales minus 2 lakhs. So that will be 74 minus 2, 72. 72 lakhs divided by 24. Current asset is 24 lakhs. So it's 3 times. Which of the following is not an activity ratio? Interest coverage ratio, which is a solvency ratio. 37th question. Which of the following accounting ratio comes under activity ratio? Trade receivable turnover ratio. Which of the following is not an activity ratio? Interest coverage ratio. 39. Activity ratios that are calculated for measuring the efficiency of operations of the business based on effective utilization of resources. A is exactly true. Current ratio and quick ratio are liquidity ratios. Reason is also true. Both are true, but they are not the correct explanation for each other. All right, children, with that, we have come to the end of activity ratios. And we'll be moving on to profitability ratios in the next session, next video. You people have fun. All the best. Bye-bye.